there's a cycle. There are three types of monetary policy, and you can almost judge it. There's first monetary policy, one I call it interest rate policy. You move the interest rates up and down. Then when you hit zero interest rate, you don't have that anymore. The next policy that you have is what I call monetary policy 2, which is also called quantitative easing, where a central bank buys bonds from investors, and then it goes in the hands of investors. The money goes to other investments, and investments go up, and those who have investments do well, and so on, but it doesn't trickle down in the same way.
Right.
Okay, that's monetary policy.
We're in number 2 right now?
No, we're in number 3 right
okay.
now. Monetary policy 3 is when there needs to be a redistribution of wealth. And the way that works is that only the federal government can determine where the money goes. The federal government gets to determine how much I tax and where I distribute it. And the central bank gets to determine how much there is of it, how much money there is of it. And so when the central bank works together with the central government to direct money to give it to others in that way, which increasingly then bypasses investors to some extent and gets money into the checks that we sent the money around to be able. And so we're in monetary policy 3, where there's a coordination of monetary and fiscal policy to redistribute wealth, to redistribute money in that way. We're in that kind of monetary policy 3. And then you could judge the size of the deficits and how they're being met. And so the debt problem is not a debt problem like we're not going to pay you off those debts, because at the end of the day, they don't choose to pay them. They don't choose to have a debt crisis. At the end of the day, it's just a question of how long it takes them to print more money to monetize those things. So in 1929 to 32, and 32 was when they printed the money, then stocks went up and everything went up. 1929 to 32 took a long time. 2008 took a lot less time. One took 2.5 years. One took, maybe 9 months. This time took like that. And so the next time along those lines, that's what you're going to experience. And then you have that kind of devaluation. So you can see that that's where we are in the cycle. Each of the stimulants has been greater than the one before it. So if you start in, let's say, 1980, and every interest rate increase and every interest rate decrease has brought the interest rates to a lower level. Every peak, every trough in interest rates down till you hit zero. And then when you hit zero, every QE has been larger than the one before.
Is there a way out of the cycle then?
Well, it's like asking, what do you do with the debts? The mechanics of it is, have an interest rate that is below the nominal growth rate and below the inflation rate. So you must have an interest rate that way, because think of it this way. If nominal growth in the economy, in other words, inflation plus real growth, let's say it was 3 and 3 or 2 and 2, and that's 4 or 5 or 6, and you kept interest rates at 0, then you are going to reduce your debt to GDP, right? Because you reduce debt service. So if you look at the times that it's been most stretched in history, the world wars would have been the most. If you look at the amount of debt creation and the monetization, you would go back into the 30 to 45 period, and you would see how that operates. So they hold the interest rate down because what you have is the central bank becomes the owner. Right. And the central bank, when they become the buyer, they can tolerate whatever the central bank wants. If the free market goes away and the central bank wants it, that they could hold it. And they hold that interest rate while inflation rate rises. And then what you do is you see your loss of purchasing power, such as we're seeing if you hold it in debt. And that's one of the ways you deal with debt.